been told in note number 2 that owing to an industrial dispute, suppliers of iron sheets have estimated that only 5,124 square meters of iron sheets are available for the period. In our first part, we have iron sheets that have been given, and it's given in shillings. We've been told that the iron sheets cost 1,000 shillings per square meter. So we want to know what is the quantity of iron sheets that is required in the production of 1 unit. That is in one production of 1 unit of this product, or in this case, doors. So we say that if we need 1,000 shillings, iron sheets cost 1,000 shillings per meter. If 1,000 shillings are required in the purchase of 1 meter of these iron sheets, and when you look at security under direct materials, iron sheets costed 10,920. So what about 10,920? How many meters were used in the production of 1 unit of this security door? So to calculate that, we are simply taking 10,920 times 1 meter, and we divide that by 1,000. It will give us the number of meters that are required to produce 1 door of, in that case, security. So 10,920 divided by 1,000, this gives us 10.9 meters. 10.92 meters, meaning to produce 1 security door, we require 10.92 meters. This is security. Then we do the same for house. How many meters will be required to produce 1 door of house? We are told to buy 1 meter, you require 1,000 shillings. What about 11,760? How much will be required? So we are simply taking 11,760 times 1, we divide by 1,000, which will give us 11.76 meters. That is for house. And then lastly, we do for office. For office. So for office, if it takes 1,000 to get 1 meter, then what about 10,500? This is the same as 10,500 times 1 divided by 1,000, which will give us 10.5 meters. So we bring it here. Meters required per unit. Meters required per unit for security is 10.2, so 0.92, we multiply that. For house is 11.76, multiply that. Then for office is 10.5, we multiply. So we simply multiply, and then we'll be able to get the total. So why are we multiplying? Meters required per unit. To produce 1 unit, you require 10.92. What about producing 200 units? So it is simply multiplying. That is 10.92 multiplied by 200. This will give us 2,184. These are meters. So this is meters total meters required. Total meters required. So that will be 21,684. Then 200 times 11.76. This will be equal to 2,352. And then lastly we have 160 multiplied by 10.5, which is 1,680. So the total, we now take the total of this plus that, plus 2184, which will give us 6,216. So it means that if this farm is to produce all the 3 types of doors, then it requires 6,216 meters. It will require 6,216 meters. But we have what is available. So we want to compare with what is available and what is required. So we have meters available. So meters available according to the question is 5,124. When we subtract this, we are getting what we refer to as a shortfall, which is now the difference, minus, this is 6216 minus 5124, 1092. So the shortfall is 1,092. Shortfall meaning there is a shortage of 1,092 meters. So we can now prove that iron sheets is a limiting factor. Iron sheets is a limiting factor. So that's the shortfall. After determining the shortfall, we are now moving on to calculate the contribution per limiting factor. We calculate contribution per limiting factor. This is part B, contribution per limiting factor. Contribution per limiting factor. So to calculate contribution per limiting factor, this equals contribution per limiting factor equals contribution per unit. We divide this by limiting factor per unit. So to calculate contribution is just selling price per unit minus variable cost per unit. So we'll have it in this format. We have door type. We have security door. We have house. We have office. We have office. So door type, security, and then office. Security, house, then office. So we begin with the selling price per unit. We were given the selling price per unit for security. For security is 24,500. For house is 26,040, and then office is 26,600. We less variable costs. I'll do this under our workings, variable costs. Variable costs I'll do for security, for house, and for office. So the variable costs given, we have direct materials, steel bars and iron sheets. And then we also have labor, machining, and spraying. So we simply get the total. So for security, we are simply taking 3,500 plus 10,920 plus 2,100 plus 980. This will give us total variable costs. Total variable costs for security: 3,500 plus 10,920 plus 2,100 plus 980, which is equal to 17,500. Then for house, we have 1960 plus 11 plus 11,760 plus 1,400 plus 560. This equals plus 560. This will be equal to 15,680. And then for office, we have 4,200 plus 10,500 plus 2,660 plus 840, which will equal to 4,200 plus 10,500 plus 2,660 plus 840. That is 18,200. 18,200 shillings. So those are our variable costs. We bring these figures here. So we have 17,500, 15,680, then 18,200. Subtract that to get contribution per unit. Per unit. So contribution per unit for security is equal to 7,000. For house is equal to 10,360. And for office is equal to 8,400. We calculate contribution per limiting factor, contribution per limiting factor. contribution per limiting factor. So we say that contribution per limiting factor is contribution per unit. So our contribution per unit, so these are in shillings. Contribution per unit is 7,000 for security. So we'll have 7,000 divided by the limiting factor per unit, that is for security. From our first table, the limiting factor was the number of meters, and for security was 10.92. So we divide this by 10.92 meters. These are shillings. Then for house, the contribution per unit is 10,360 shillings. We divide this by the limiting factor for house, which is 11.76 meters. 11.76 meters. Then for office, we have 8,400 shillings. We divide by the limiting factor, which is 10.5 meters. So this will give us contribution per limiting factor. For security, we'll have 641 shillings. For house, we'll have 881 shillings. Then for office, we'll have 800 shillings. Once we have the limiting factor per unit, we now rank the products. So we'll do the ranking. In ranking, we are simply ranking the product either as number 1, number 2, or number 3. So the one that has the highest contribution per limiting factor will be number 1, and the one that has the lowest will be number 2, and so on. So according to what we have, house has the highest contribution per limiting factor, and this will be our number 1. Can remove these workings. This will be our number 1, followed by office, which will be 2, and then security will be number 3. So what does it mean? It simply means that since the farm is limited by the number of meters that it needs to use to produce these doors, then it has to consider producing house because it is more profitable. If we have any number of meters remaining, then we should use it to produce office, which is our number 2. And if we have any other remaining, then we can produce security. That's what it means. So let's now calculate the production mix. Production mix for the farm. We determine the production mix of the farm. So we need to show the ranking. We show the door type. We'll show the meters required. And then units to be produced. So the ranking is 1, 2, and 3. So the first door type is house. According to the ranking, then number 2 is office. And number 3 is security. Then meters required, we did this in step number 1. The meters required to produce house is 2,352. 2,352 meters. Those are the meters required to produce a house. Then office is 1,680. 1,680. Our maximum must equal 5,000. The available was 5,124, meaning we cannot go beyond that. So we have 5,124. So that means we can produce all the units of house door type, and the units that were to be produced according to the question in note number 1 is the sales for the month of December 2018 are as follows. So we need to produce 200 units of house. So since we only need 2,352 meters, we'll be able to produce all the units of house, which are 200 units. We can also produce all units of office. Why? Because we only need 1,680 and the units for office were 160. So we need to know how many meters are remaining from the 5,124. So we already have used 2,352 plus 1,680. From 5,124, we still have 1,092 meters, which we can use to produce security door type. So security required 2,184 meters, but we only have 1,092, meaning we cannot produce all units of security door type. And therefore, we need to determine how many units we need to produce. So according to the question in still part number 1, for us to produce 1 unit of security, we require 10.9 meters. These are workings for security door type. So 10.92 meters are required to produce 1 unit of the product. But what we have is only 1,092 meters available. Then how much units can we use these meters to produce? So we are simply taking 1,092, we multiply by 1, we divide by 10.92 to know the number of units that we'll produce because of the limited meters. And this will give us 100 units. So meaning we can only produce half of the units, and therefore we are only producing 100 units of this product. And this is how we were to answer this question number 2. So question number 2 was in 2 parts. To give a summary, the first part required you to make a decision to do it, to make a decision on economic order quantities, which is the optimal economic order quantity that we should advise the firm to purchase its products at. And in part 2, we are making decisions to do with the limiting factors. So you can read more on, in part number 1, read more on a single price model, where in case you are only given 1 discount, then how do you advise the management where only 1 discount is given? And then for part 2, we have other decisions like make or buy decisions. We have acceptance or rejection of orders. Then we also have decisions where you are either I've talked about make or buy decisions, acceptance or rejection of orders, and dropping a product. So you can read more on those other decisions that are likely to be set in the upcoming exams. And that is the end of our question number 2, which marks the end of our session. So bye-bye. I welcome you to our next session, which will be handling question number 3.
Welcome to Manifested Publishers.
Hello learners, welcome back to Manifested e-learning platform. We are still continuing our previous lesson on reading and reading comprehension. The title of the comprehension was Gathoni's grandfather. So in our previous lesson, you were learning about the vocabulary words, the words that will meet in the story and their meanings. You are supposed to understand the words first before we read them in the comprehension. So for this lesson, we are now going to read the story. So make sure that you are paying attention, and you will also, because at the end of this lesson, I will require you to answer questions about the story. Now, as we said earlier, that the title of the comprehension is about Gathoni's grandfather. Therefore, the story is all about a grandfather who belongs to a child called Gathoni. So, Gathoni's grandfather. Gathoni came from a large family. She had many brothers, sisters, uncles, aunts, and cousins. However, in school, Gathoni used to hear her friends talking about their grandparents. She had never met her grandparents. One day, Gathoni asked her father, "Father, do I have grandparents?" "Your grandparents are my parents and the parents of your mother. Sadly, they died when your mother and I were still children." Gathoni felt a little sad. "Can you tell me something about them?" This question led to an interesting conversation. "I will tell you about one of your grandfathers. That is my father," her father said. Nobody knows where he came from. He just arrived at my grandfather's home one morning." "Just like that?" asked Gathoni. "Yes, just like that," her father said. He was a young boy and he did not know the name of his parents. He did not even know his own name. Nobody was able to find out where he came from. "My grandfather, who is your great-grandfather, guessed that the boy was an orphan, so he welcomed him into his home." "What did people call him?" asked Gathoni, with a lot of curiosity. Her father explained that since the boy did not know his name, the villagers said they would look for a name for him. In the meantime, he was given duties, looking after goats and sheep during the weekends. After a short time, the goats and sheep increased in number. One member of the clan said that they should call him Nyingi. Nyingi is a Swahili word that means many. Nyingi became his name, and my grandfather adopted him as his son. "Thank you for the information. I will look for more information about family in my encyclopedia," said Gathoni. So I'm going to read the story once more as we learn more about few concepts that are arising from the story. Now, the title of the story is Gathoni's grandfather. Therefore, we are going to learn more about Gathoni's grandfather. So, Gathoni came from a large family. She had many brothers, sisters, uncles, aunts, and cousins. However, in school, Gathoni used to hear her friends talking about their grandparents. she had never met her grandparents. Now, in the first part of the story, we are now introduced to Gathoni's family. The writer is telling us Gathoni came from a large family where she had brothers, sisters, uncles, and aunts and cousins. But Gathoni did not have grandparents. She only came to learn about grandparents from her friends at school. Sometimes we learn things from friends. When you are at school, there are things you do not know when you are at home. But when your friends are talking about them, you now want to know more about that. So it is the same case with Gathoni. She had her friends talk about their grandparents at school, and she had never met her grandparents. Let's see what happened next. So one day, Gathoni asked her father, "Father, do I have grandparents?" Then, now Gathoni has now made a step ahead. She has gone to ask her father about the whereabouts of his grandparents because she has never met them. "Your grandparents are my parents and the parents of your mother. Sadly, they died when your mother and I were still children." Now we see Gathoni's father is now telling Gathoni about the grandparents. He's telling Gathoni that the grandparents are his parents and also the parents of Gathoni's mother. That tells us that grandparents are the parents of either your mother or your father. So Gathoni's father continues by telling her that the parents died long time ago when Gathoni's father and Gathoni's mother were still very young. So Gathoni felt a little sad. "Can you tell me something about them?" This question led to an interesting conversation. Now Gathoni wants to know more about her grandparents. What happened to them? Why did they die so early? So it led to an interesting conversation, a discussion about the grandparents. So I will tell you about one of your grandfathers. That is my father. Her father said, "Nobody knows where he came from. He just arrived at my grandfather's home one morning." Just like that, asked Gathoni. Now Gathoni still wants to know more about his grandfather. And in this case, his father is telling her about the story of her grandfather from his father's side, the father of his father. So, "Nobody knows where he came from. He just arrived at my grandfather's home one morning." Just like that, asked Gathoni. "Yes, just like that," her father said. "He was a young boy and he did not know the name of his parents. He did not even know his own name. Nobody was able to find out where he came from. My grandfather, who is your great-grandfather, guessed that the boy was an orphan, so he welcomed him into his home." Now, the part that I have read, we are now introduced to the great-grandfather of Gathoni. A great-grandparent is a parent to your grandparents. Remember that our grandparents also had parents, so we shall call them our great-grandparents. So my grandfather is your great-grandfather. Guess that the boy was an orphan. Remember that an orphan is a child whose both parents are dead or died. So he welcomed him into his home. "What did people call him?" asked Gathoni with a lot of curiosity. Being curious, you want to know more about something, you are anxious, you want to now understand. The boy came, he did not know his name, he did not know the name of his parents, and what happened? If he did not have a name, what did people call him? So her father explained that since the boy did not know his name, the villagers said that they will look for a name for him. In the meantime, he was given duties. He was given some tasks to perform. So the tasks are this: looking after goats and sheep during the weekends. After a short time, the goats and sheep increased in number. One member of the clan said that they should call him Nyingi. Now, this particular boy was given duties. He was supposed to look after goats and sheep during the weekends on a Saturday or a Sunday. But after a short time, the goats and sheep now increased in number. They became many. So one member of the clan said that they should call him Nyingi. Nyingi is a Swahili word that means many. Nyingi became his name, and my grandfather adopted him as his son. Now, after this boy came to the village and they assigned him some duties of looking after the goats and sheep on a weekend, he was later adopted by Gathoni's grandfather. Thank you. Nyingi is a Swahili word that means many. Nyingi became his name. He was now given a name. He was called Nyingi. And then word Nyingi is a Swahili word that means many. And my grandfather adopted him as his son. Now, Gathoni's great-grandfather adopted Nyingi as a son. Thank you for the information. I will look for more information about family in my encyclopedia, said Gathoni. Now, Gathoni wanted to know more about family, and instead of asking his father about family, she decided that she'll get an encyclopedia, and the encyclopedia will give her more information about a family. Now, an encyclopedia is a book that gives information about many things. When you want to know about families, you want to know about plants, about animals, you get it from an encyclopedia. So that's all about Gathoni's grandfather. We have been introduced to Gathoni's grandfather, and in the story we have also come to learn about his great-grandfather. Now, I want us to answer questions on the comprehension that we have read, but before that, I shall answer with you the first 3 questions, then you shall do the rest. Now, the questions are here. The first question, write 3 words about family from the passage. Write 3 words about family from the passage. Write 3 words about family from the passage. The question has already guided you on what you're supposed to do or where you're supposed to get your answers. Remember that questions from a comprehension or a passage, their answers are always in the passage. So write 3 words about family from the passage. You go back to the passage and get 3 words about a family. Now, from our very first paragraph, we are able to get the answers to our question. Now, Gathoni came from a large family. She had many brothers, sisters, uncles, aunts, and cousins. However, in school, Gathoni used to hear her friends talking about their grandparents. She had never met her grandparents. Now, from the very first paragraph of our passage, we already have some names that talk about family. We have brothers. So we have brothers. Then it has also talked about sisters and uncles. So the question only asks us about 3 words about family from the passage. Now, these are just some of the words that are in the passage about family. We still have more. We have grandparents, we have great-grandfather, we also have ants. Then the second question, what made Gathoni feel a little sad? What made Gathoni feel a little sad? So what made Gathoni feel a little sad from the story? What made Gathoni feel a little sad? So you go back to the story and look for a place where Gathoni felt a little sad and you read the part. So from the story, the part where Gathoni felt a little sad is on paragraph 1, 2, 3, the fourth paragraph. So you read the fourth paragraph. And I'll read, Gathoni felt a little sad. Can you tell me something about them? This question led to an interesting conversation. Now, before Gathoni felt a little sad, there is something that she was told by his father that made her feel sad. So let's find out from the story, the third paragraph. Your grandparents are my parents and the parents of your mother. Sadly, they died when your mother and I were still children. Gathoni felt a little sad. So, what made Gathoni feel a little sad? Gathoni felt a little sad because both grandparents had already died. After his father gave her the news that the parents had died when they are still young, it made her feel sad. Remember, news about death, about sickness are sad news. They do not make us happy, and that is why Gathoni felt sad. So Gathoni felt sad because his father told him the news about the death of his grandparents. So what made Gathoni feel a little sad? Gathoni felt sad about the death of her grandparents. So Gathoni felt sad about the deaths of her grandparents. That is what made her feel sad. So I'm only going to answer the first and the second questions, which I have done. Make sure that when answering the questions from the comprehension, you go back to the passage. And if the answer is not in the passage, you are going to think of a possible answer. Then you write your answer. Remember that we think using our minds. We do not think using our heads. So, where you'll be required to think, please do so and give your answers. Meanwhile, I want you to copy the questions that are right on the board and you will answer them. Now, here are the questions from the passage. Only 3 questions, and the instructions are guiding you on what to do. Answer the following question. Number 1, why did Gathoni's great-grandfather welcome the boy into his home? Why did Gathoni's great-grandfather welcome the boy into his home? So you write the answer. The second question, what tells us that the boy looked after the goats and sheep well? What tells us that the boy looked after the goats and the sheep well? And lastly, why do you think it was important to give the boy a name? Why was it important or necessary for the boy to be given a name? So finish the work and also go through your answers just to ascertain some mistake that you might have committed. Otherwise, thanks for being good listeners. Hope to see you next time.
Hello candidates, welcome to Manifested Publishers e-learning portal. Today is a new session. We've been doing question number 1 and 2. Today I'll introduce you to question number 3 of the same paper, that's May 2021, of Management Accounting. So my name is Celestine Wadabusi. I instruct you to have calculators so that we'll work together as we move on. Question number 3 comprises 2 parts. We have part A and part B, and part A reads, describe the 3 main stages of the activity-based costing. That is ABC system. What are the 3 main stages? Part A of question 3, 3 main stages. 3 main stages of activity-based system. So the 3 main stages include Roman 1, organization of the major activities. Organization of the major activities of an organization. Then stage 2, determination of cost drivers. Stage number 3, collection of costs into cost pools. And I can add you one more stage, absorption of service costs to production departments. So in ABC costing system, we assume that there are activities that cause cost to be incurred. So the first stage in activity-based costing is identify these major activities assumed to cause cost to be incurred. So once you have identified these major activities that are assumed to cause cost to be incurred, we collect them. Those that are of the same nature are put together into what we refer to as cost drivers. And therefore, our second step is determination of the cost drivers. Cost drivers is a group of activities that cause cost to be incurred. Once you have determined the cost drivers, the next thing is what are those costs that are incurred when these activities work. So we determine what we refer to as cost pools. A cost pool is simply a collection of costs that is associated to a specific cost driver. Like when we have activities of, we have a group of activities that is causing cost to be incurred, and then we identify the related cost to those activities into one group. We refer to that as a cost pool, which is our stage number 3. And once we've determined the cost drivers and cost pools, the last stage is to absorb the service cost. We transfer all the service cost into the production departments. And those are the 3 stages or the 4 stages of activity. So the question only required 3. I've added you one more. Part B reads, Bix Limited reapportions the costs incurred in two service cost centers, namely material handling and inspection, to the three production cost centers of machining, finishing, and assembly. The following are the overhead costs which have been allocated and apportioned to the first cost centers. So we have machining, finishing, assembly, material handling, and inspection. We've been given the amount which is in millions. Then estimates of the benefits received by each cost center are as follows. We have machining, finishing, assembly, material handling, and inspection. So we have the details for material handling and details on inspection for all other departments. They required calculate the charge for overhead to each of the three production cost centers, including the amounts reapportioned from the two service centers using Roman 1, the continuous allotment, in brackets, repeated distribution method. So we want to begin with the Roman 1. This is part B, Roman 1. Part B of question 3, Roman 1, we are required to apportion overheads using continuous allotment or repeated distribution method. In continuous allotment method, we normally assume that we have service departments and we have production departments. So service departments are providing services to each other as well as to production departments. So when we have such happening, it means that we have to do what we refer to as reciprocation of one service department with the other service department. And therefore, the process normally involves repeated apportionment until we ensure that we have zeros in the service department. And to do that, we'll use a table that will help us to do the apportionment. So we'll have space, then we have basis of apportionment. We'll have the department, machining. We have machining. We have finishing. We have assembly. We have material handling, and then we'll have inspection. So we'll have a table. So the values are in shillings. The values are in shillings. So we'll have these in shillings. So we have a table that is showing the basis of apportionment, machining, finishing, assembly. So in the question we were told that machining, finishing, and assembly are production departments. Material handling and inspection are service departments. When you look at the question paper under estimates of benefits received by each cost center are as follows. Material handling is providing 30% to machining, 30% of its services to machining, 25% of its services to finishing, 35% of its services to assembly, and it is providing 10% of its services to inspection department, which is a service department. Then we have inspection is providing 20% of its services to machining, 30% of its services to finishing, 45% to assembly, 5% to material handling, which is a service department. So we need to identify the allocated and apportioned overheads which are given in the question. We have a note, the following are overhead costs. So we have allocated and apportioned overhead costs. Allocated and apportioned overhead costs. For machining, this is in millions, shillings in millions. Sorry, shillings is in millions. Shillings in millions. It is in shillings in millions. Shillings are in millions. Also show that millions, and then this is also shillings in millions. In millions. So for machining, we have 400. That's 400 million. This is 200 million, 100 million, 100 million, and 50 million. That is the allocated and apportioned overheads. So we need to identify the basis for apportionment, but before we find the basis of apportionment, remember we have two service departments, material handling and inspection. So in continuous allotment method, it doesn't matter which service department you begin with. You can either begin with the material handling or inspection. So let's begin with by apportioning material handling. You simply write apportion material handling. Remember, apportioning is simply referring to division of a value to various departments that used that service. So material handling had 100 million. This is what it means. It simply means the 100 million incurred under material handling was incurred simply because material handling was providing services to machining, finishing, assembly, and inspection. And therefore, we are to transfer 100 million to these other departments that use the service in the ratio provided. I'll use this for our workings. This is our working space. Sorry, workings. Just have workings. And this is working number 1. Basis of apportionment for material handling. So material handling is providing 30%. We have the ratio of 30% to 25% to 35% to 10%. 30 to 25 to 35 to 10. So we are to identify the right ratio that we need to, which we'll use under the basis of apportionment. And for us to find the ratio, we are simply to use the lowest figure that is divisible in all these values. And the lowest figure is 5. So 5 will be divisible in this. So 5 will be into 30, 6 times, to 25, 5 times, to 35, 7 times, and to 10, 2 times, and that will be our basis of apportioning this amount. So we'll have 6 to 5 to 7 to 2. So when we take 6 plus 5 plus 7 plus 2, it will give us a total of 20. So we remember we are apportioning material handling with 100. So to calculate the amount for finishing department, this is working 2, finishing department. This is material handling ratio. Finishing department will be equal to 6 over 20 times 100. 6 over 20 multiplied by 100, and this will give us 30. So we apportion that 30 to machining. We do the same to, this was machining, not finishing. This was machining. And then to finishing department, we'll simply take 5 over 20 times 100. 5 over 20 times 100 will give us 25. So we'll have 25, and you do the same for the others. Take 7, divide by 20 times 100. It will give us 35 to assembly, and then 2 over 20 multiplied by 100, which will give us 10 to inspection. So we have transferred the whole of this amount, and therefore we make it a negative, but we now add the value in the inspection column, and this will give us 60. Then we apportion. Next is to apportion inspection. We apportion inspection. And what is the ratio for inspection? This is working 3. Inspection ratio. Inspection ratio. So according to the question, we were told that inspection provides 20%. So we have 20 to 30 to 45 to 5. The lowest figure that can be divided in all these is 5. So 5 into 20 is 4, into 30, 6, into 45, 9, and into 5, 1. So we have the ratio of 4 to 6 to 9 to 1. And so to find for machining, remember the amount that we are apportioning is 60. We are taking 4 plus 6 plus 9 to get the total. 4 plus 6 plus 9 plus 1, which will give us 20. And to apportion for machining, we will take 4 divided by 20. We multiply by 60, which will give us 12. Can show that under working number 4, machining. We are simply taking 4 over 20 and we are multiplying by 60, which will give us 12 shillings. 12 shillings. We do the same for finishing. This will be 6 over 20 multiplied by 60, which will give us 18. Then for assembly will be 9 divided by 20 multiplied by 60, which will give us 27. And then to material handling is 1 divided by 20, and then we multiply by 60, which will give us 3. We make this a negative. Why? Because we have transferred the whole of that figure to other departments. So under material handling, we still have 3. Our intention is to ensure that we have zeros in the service department. And therefore, we say we repeat the process. So we repeat to apportion material handling. And what are we apportioning? We are apportioning in the ratio of 6:5:7:2. And what we are apportioning is 3 to ensure that it becomes a 0. So we'll have 6 plus 5 plus 7 plus 2, which is giving us 20. We take 6 divided by 20 times 3. This will give us 0.1, which can be rounded off to 1. Then 5 divided by 20 times 3 will give us 0.75, which is equal to approximate to 1. Then 7 divided by 20 times 3 will give us 1.05, which is 1. And then 2 divided by 20 times 3 will give us a 0. So here we have a 0, and here we have transferred the whole of this. And that simply means our solution has been reached, and we simply get the sum. So when you get the total, our service departments have zeros. So this is a 0, and we are now supposed to get the total for the production department. We get the total for production department. So for machining, we have 400 plus 30 plus 12 plus 1, which will give us 443. Then we have 200 for finishing plus 25 plus 18 plus 1, which will give us 244. Then 100 plus 35 plus 27 plus 1 equals 163. And then we'll be done with part 1 of that question. Then part 2 of the question. Part 2 of the question, we are required to use algebraic method. Algebraic method is any method that can help in solving a pair of equations. So a pair of equations here is referring to a simultaneous equation. So in this case, we'll use simultaneous equations method or simultaneous equations method where we will have to solve using elimination method. So it is normally an alternative method to continuous allotment, and therefore it should yield the same results. And how do we do this? So let's do part 2. This is question number 3, part B, Roman 2. Roman 2. We are using the algebraic method. Algebraic method. This was continuous allotment method. Continuous allotment method, and this is algebraic. So we are required to formulate 2 equations. Why 2 equations? We have 2 service departments. So when we have 2 service departments, we are required to formulate 2 equations. And each equation should state the original or the allocated or apportioned overhead cost and the proportion of the other department that is apportioned or to be apportioned to it. So when you look at this paper, we have material handling, which is providing 10% of its services to another service department, which in this case is inspection. And inspection is providing 5% of its services to material handling, which is also another service department. So we are to formulate 2 equations as follows. Let material handling total cost be represented by X. So we are representing material handling by X, and then we let inspection total cost be represented by letter Y. So X is representing material handling and inspection is represented by Y. So we want to formulate the equation for material handling, which is represented by X. So we'll say material handling, or X, equals the original and the allocated amount that is to be apportioned or allocated to material handling. From this table, you can see that it is 100 million. So the equation is formulated into two parts. One, it must have the total, the original total or the allocated, plus the proportion of the other service department. Proportion of the other service department. When you look at that question, we have machining, finishing, assembly, material handling, and inspection. Material handling is being provided by inspection with 10%. Material handling is providing services, 30% of its services to machining, 25% of its services to finishing, 35% to assembly, and 10% to inspection. And then inspection is providing 20% of its services to machining, 30% to finishing, 45% to assembly, and material 5% to. So the other proportion, or the proportion of the other service department, so the other service department here is inspection, and inspection is providing 5% of its services to material handling. So we'll have the original amount plus the proportion of the other. So the other service department, inspection, which is plus 0.05 Y. And then we also formulate for inspection represented by Y will be equal to the allocated amount to it is 50. In this case, not 60, it is 50. So we take 50 plus the proportion of the other service. So the other service department is material, and material handling was providing 10% of its services too. So we take 0.1 x, 0.1 x. Then we rearrange the equation into simultaneous format. So to rearrange this, we'll have x equals, we'll have x minus, we are taking this, the other side, 0.05 y, which will equal to 100. And this will become our equation number 1. We do the same for the second equation. We are bringing 0.1 the other side, so we'll have negative 0.1 x plus y equals 50. And this becomes our second equation, which we now solve using simultaneous equations, using elimination method. So to solve this, we want to eliminate values either at x or y. Eliminating values at x, we simply multiply negative 0.1 and the second line by 1. So I've cross multiply. Take negative 0.1, multiply by the first line, take 1, multiply by the second line, and then we'll be able to solve. So negative 0.1 times x is equal to negative 0.1x. A negative times a negative will be a positive. So we have 0.1 times 0.05 will have 0.005 y equals 100 times negative 0.1 will be equal to negative 10. We multiply one by the other line, so this will remain to be negative 0.1x plus y equals 50. And then we subtract. So we take negative 0.1 minus minus. So negative 0.1 minus minus will become, is the same as negative 0.1 plus 0.1, which will give us a 0. And then we have 0.005 minus 1, which will give us negative 0.995y equals negative 10 minus 50 will give us negative 60. Then we find y. So y will be equal to 0, negative 0.995y. We divide both sides by negative 0.995, which will be equal to negative 60 over negative 0.995. Solving that, y will be equal to y will be equal to 60.3. Then we substitute to get the value of x. We can use the first line. So we have x minus 0.05y equals 100. We already have y, the value of y, so this will be x minus 0.05, 0.05, not 0.5, yes, 0.05 into bracket 60.3 equals 100. So this will be equal to x minus 3.015, 0.05 times 60.3. 3.015 equals 100. So selecting the like times, x will be equal to 100 plus 3.015. So x is just equal to 103. We round it off to a whole number, 103. So first step, we have formulated the equations. The second step is now to do the apportionment. And for us to do the apportionment, we'll use the table as follows. We'll use the table. So we'll have space, then we have basis of apportionment. Then we have machining, we have finishing, we have assembly, we have material handling, and then we'll have inspection. And each is in millions. So we'll have that table. So we had it in millions of shillings. So it is all in millions of shillings. So we are beginning with allocated and apportioned overhead costs. So the allocated and apportioned overhead costs for production departments will remain the same. So for machining was 400, for finishing was 200, for assembly 100. But now when it comes to material handling, we are not using the original amounts of 150, but we are now using the results of the simultaneous equations. So Y represented inspection and X represented material handling. So for material handling, the amount will be 103 and inspection will be inspection was 60.3. It will be 60.3. So we begin by apportioning either of the service department. So we say apportion material handling. And the ratio will not be the same as in this case. We are to use the percentages the way they are. So what are the percentages? For material handling to machining was, we'll use 30%, 25%, 35%, 30%, 25%, and 35%. We are apportioning only to production departments. So we are to apportion 103 using these percentages. So we calculate for finishing. For finishing, we'll have, can have the working part, workings. For machining, we are simply taking 30% times 103. So 30% times 103, we get 30.9. And 30.9 is what is to be apportioned to machining. Then finishing will be equal to 25% multiplied by 103, which equals 25.75. So we'll apportion 25.75. And then the last one is assembly, which will be 35% multiplied by 103, and this equals 36.05, which is just equal to 36. We make this a negative, but we don't want, I'll show the reason why I'm not making it a negative now. When you take 30.9 plus 25.75 plus 36, the total you get is 92.65, which we make a negative. And then we come here and apportion inspection. We now apportion inspection. We apportion inspection, and the percentages for inspection were 20%, 30%, and 45%. So we are apportioning 60.3%. Remember, once you've calculated that simultaneous equation, we are not apportioning any amount to the service departments. So we are only apportioning to production departments and therefore don't include any service department. So we'll have 20%. This is inspection. 20%, this is inspection. This was material handling. This was material handling. And inspection will be 20% multiplied by 60.3, which will be equal to 12.06. We apportion 12.06 to machining, then get 30% of 60.3 and apportion it to finishing, which is 18.009, and then 45% multiplied by 60.3, which will give us 27.14. Then the total of the all three, 12.06 plus 18.09 plus 27.14 will give us 57.29, which we subtract, but now we show that the balances are zeros. The balances are zeros. We say that the method is not very accurate, and because of the inaccuracy of the method, that's why we are having balances in the service departments, but they ought to be zero. So once you've done that, simply indicate that we have zeros in the service departments. Then we get the sum for the production departments. Get the sum for the production departments. So for machining, we have 400 plus 30.9 plus 12.06, which will be 442.9, which is the same as 443. And then we have 200 plus 25.75 plus 18.09, which will give us 244. Then we have 100 plus 36 plus 27.14, and this is 163. So I say that this method is an alternative method to continuous allotment, and therefore it should yield the same results. So this was question number 2. You can also use other methods. Under the same part 2, we may also be required to use a reciprocal method and then sometimes direct method. So you need to know how to calculate or to apportion overheads using direct method or direct allotment method and reciprocal method. And this marks the end of our question number 3. Bye-bye and welcome to our next session, where we'll be dealing with question number 4 of the same paper.
Hello Dana, welcome to Manifested online platform. My name is Joseph Kimani. So today I want us to continue with our topic number 2. In our previous class, we looked on various subtopic in that particular topic number 2, whereby we managed to cover on various issues. 1, we looked on how an entity should report on investment property. 2, we looked on issues to do with the event after the balance sheet date. We also looked on the issues to do with employees' benefit. Now, in today's class, I want us to continue with the same topic number 2, and we look on the issue to do with the income taxes. That is income taxes, which is governed by IAS 12, income taxes. Now, in this particular topic here, we are going to define, and also we look on how an entity or maybe how a company should account for 2 types of taxes. 1 we do have what we refer to as the current tax, and number 2, we do have what we refer to as the deferred tax. So therefore, those are the 2 types of taxes which we are going to look on how they are supposed now to be accounted for by a reporting entity. But even before you look on those 2 types of taxes, when talk about income tax, as far as a company is concerned, this is the amount of tax which a company is supposed to pay to the government based on the profit which is reported by a company at the end of the financial year. Yeah, because what we need to remember from commercial law is that a company is deemed to be a legal entity. So means that a company then has to pay tax just like any other individual now to the government. Now, first of all, to start with the first type of tax here, that is the current tax. This refers to the actual amount of tax which now a company is supposed now to pay to the government in respect now to the trading activities of a certain reporting period. So mean that this is the actual amount of tax, payable to the tax authority, in respect to the trading activities, activities of a certain accounting period, So therefore, current tax will refer to that amount of tax which now a company is supposed to pay. And also what we need to remember from taxation is that this particular amount of tax which the company is supposed to pay should always be based on what refer as the taxable profit. And also from taxation, you must be in a position to remember how we compute the taxable profit. So therefore, the current tax, therefore, we say is the actual amount of tax which is supposed to be paid. Now, in this particular case, we also need to look on how this particular tax is supposed now to be recognized by a company. That is recognition of a current tax. Now, this tax which now a company is supposed now to pay in a certain accounting period, according to IAS 12, it should be accounted for as an expense. So mean that the amount of current tax, this will be accounted for as an expense, in the income statement, and that's why whenever we are to prepare the income statement, what we do is that once now we get the profit before tax, we are supposed to proceed and we less the current tax. So the reason why we less that current tax, it is because that tax is an expense in the income statement. Also, according to IAS 12, if at all maybe we have any unpaid tax, or what we refer as a accrued tax, this is basically the tax now which the company has not paid, maybe at the end of a certain accounting period. Now, this particular tax which has not been paid, according to IAS 12, it should be accounted for by the reporting entity as a current liability, Now, on the other hand, there are some cases whereby a company may have paid more tax than it was supposed to pay, meaning that in such a case, then we may be having what we refer to as a prepaid tax. Now, such a prepaid tax, then this should be accounted for by the reporting entity as a current asset, because by the end of the day, the company can be able to recover that particular tax from from the government. But on the other hand, what you need to remember is that whenever now we are to determine the actual amount of tax which is supposed to be paid by a company, we have said that that tax, or basically now the current tax, which we have said is the actual amount of tax, amount of tax, this is always computed. This is computed, or it is determined. It is determined based on the taxable profit. It is determined based on the taxable profit. Now, in this case, when we talk about what refers as the taxable profit, this we say is that particular profit which is computed by the company based on what refers as the existing tax laws. Meaning that for us to be able to compute the taxable profit, we take the taxable incomes and then we less only the allowable expenses. So therefore, the amount of tax which is supposed now to be paid, it is determined, or it is computed based on the taxable profit. And therefore, what you need to note is that as at the end of the year, the amount of tax which will be charged in the income statement is usually a provision. Is usually what? A provision, meaning that the amount of current tax which is charged in the income statement at the end of the year, at the year end is usually a provision. A provision. Now, in this case, the reason why we say that that particular amount is a provision, it is because the amount of tax which is supposed to be paid, it will always be based on taxable profit. Now, what we know from taxation is that for a company to be able to compute the taxable profit, that profit is always computed from the accounting profit. Now, in this case, there is a difference between taxable profit and basically accounting profit. Before we go back to this, so when talk about what refers as a accounting profit, we say that this is a profit now which is computed by the company based on the accounting concept and also the accounting policies applied by by an entity. And therefore, once an entity prepares the income statement at the end of the year, that profit which is reported there, or what in other terms we refer to the profit before tax, that is the accounting profit. It is the accounting profit, and the tax, or the actual amount of tax which is supposed to be paid, is never determined on this. Rather, it is determined based on taxable profit. And therefore, what we are saying is that once now the income statement has been prepared at the end of the year, then the profit which will be computed will be the accounting profit. And therefore, that particular amount of tax now which we provide for in the income statement, it will actually be be a provision, because now the taxable profit can only be determined after the preparation of the income statement. So therefore, that is very, very important, that this particular amount of current tax which we charge in the income statement, it is not the actual amount of tax which will be paid, but rather it is a provision. And therefore, once now that a provision has been provided for, or the amount of current tax has been provided for, then that will give rise to something known as over provision, or other provision, provision of current tax. So in our case here, we need to know how this over provision and also other provision arises. Maybe we start with what we refer as the over provision of current tax Now, in this case, this will actually arise if the amount of tax, or the amount of current tax which was provided for at the end of the year is then more than the amount of tax which was actually supposed to be paid. Like, maybe let's assume that when the income statement was being prepared at the end of the year, the amount of current tax which was provided for, maybe at the end of the year 2018 was something like 20 million or something like 20 million, because what we have said is that whenever the company is preparing the income statement at the end of the year, that amount of tax which it will be including there, it is just a provision, because we have said the actual amount of tax to be paid can only be determined after the income statement has been prepared. So therefore, assuming that the amount of tax which was provided for was 20 million, and once now the actual amount of tax is determined now based on what we refer as the taxable profit, that actual amount of tax, or the actual amount of tax, then it is determined to be something like 15 million. Then in this case, you'll see that the amount of tax which was provided for at the end of 2018 was 20 million, but the actual amount of tax which was determined to be payable to tax authority, then in this case has been determined to be what? To be 15 million. So mean that in this case then the amount which was provided for in the income statement is 5 million more than the actual amount of tax which was paid. Now that 5 million here, we refer to that as an over provision of current tax, over provision of current what? Tax. Now this particular over provision of current tax, in terms of how we account for it, it is supposed to be carried forward, and then it will be used in reducing the amount of tax which will be provided for in the next financial year, meaning that the amount of over provision, in current tax, should be carried forward, definitely to the next financial year, and should be used to reduce the amount of current tax provision, or to reduce the amount of current tax to be provided for in the next financial year, or basically in the next year. So mean that if, for example, maybe in the year 2019, the company will make a tax provision, or maybe the current tax provision of something like 25 million. Now this particular over provision in the previous year then will be used in terms of reducing that particular provision, meaning that if now in the year 2019, the amount of current tax, to be provided for will be 25 million. Then what you are saying is that because in the previous year, that is in the year 2018, we had over provision of 5 million. Now that particular over provision then will be deducted, or basically will be used to reduce that particular amount to be provided for, meaning that in this particular year 2019, then the amount of current tax to be deducted from the profit before tax, then in that case it will be 20 million. So therefore that is very, very important to know how the over provision of tax will arise, that is over provision of current tax arises, and also how we account for that. Now on the other hand, we have said that we may be having what we refer to as other provision of current tax, tax. Now, the provision of current tax arises if the amount of tax which was provided for at the end of a financial year is less than the actual amount of tax which is supposed to be paid. For example, let's assume that in the year 2018, the current tax provided for at the end of 2018 is maybe 20 million. But once now the actual tax is determined, the actual amount of tax is determined, then that is determined to be something like 25 million. So then in this case you'll see that the company provided for amount of tax which was equivalent to 20 million, but the actual amount of tax which was determined now based on our taxable profit then was 25 million, meaning that then in our case here we will be having what we refer to as other provision of current tax, other provision of current tax, which in our case now will be 5 million. Now, this particular other provision of current tax, just like over provision, this is supposed now to be carried forward to the next financial year, and it should be added to the amount of tax which will be provided for in the year 2019. So mean that the other provision of current tax should be carried forward to the next year, and should be added, that is very, very important, should be added to the tax provision in that year, meaning that like assuming in the year 2019 now, which is the next financial year from the year 2018, let's assume that the amount of current tax to be provided for is Kenya shillings, maybe 28 million. Now in the year 2018 here, you'll see that we had what? Other provision. Now this particular other provision, we have said that it should be carried forward now to the next what? Or basically to this year, and then it should be what? Added to the amount of tax which will be provided for. So mean that to that then what we are supposed to do is to add now the other provision of current tax in the year 2018, which is an amount of 5 million. And that means that the amount of tax then which you are going to charge in the income statement, or which will be deducted from the profit before tax, then in our case will be an amount of what? 33 million. So therefore that how over the provision of current tax arises, and basically that's how we are supposed now to account for that. So therefore, as far as now the current tax is concerned, I think those are the various issues which are very, very important. That current tax, we have said, is the actual amount of tax which is supposed to be paid to the tax authority in a given accounting period. And what you have said is that that particular amount of current tax, then to a reporting entity, then it is an expense in the income statement. 2, we have said that if at all maybe there is an unpaid tax, then to the company that is a current liability. If now we have a prepaid tax, then that is a current asset. Then on the other hand, you also need to remember that that particular amount of tax, or the amount of current tax which is deducted from the accounting profit, is always a provision, because essentially what you have said is that for us now to be able to determine this actual amount of tax which is supposed to be paid, that can only be determined based on the taxable profit, and this profit can only be computed after the company has computed the accounting profit. So therefore, once now a provision has been made at the end of the year, then you have said it can give rise to over provision and also other provision. So therefore, in that case, you need to know how the over provision of current tax arises, how we account for that, how the other provision of current tax arises, and also still how we account for that. So therefore, as far as the current tax is concerned, that basically what you need to know. Then I want us we proceed and we look on the other type of tax, and that is the deferred tax. tax. Now, in this case, when talk about deferred tax, this is one of the area which most of the students do have a challenge in, but it is a very, very simple concept now to understand. Now, when talk about deferred tax, this is actually defined under IAS 12 as an accounting device which is now used to measure the tax effect of a transaction with what referred as the accounting accounting impact. Or in very simple terms, when talk about deferred tax, we can say that this is the amount of tax which was supposed to be paid in the current financial year, but it has been deferred and it will be paid on a later period, or it is an amount of tax which an entity or a company was supposed to recover in the current financial year, but it has been deferred and it will be recovered in the future. So therefore, in very simple terms, that is what referred as a deferred tax. But in terms of how this is defined under IAS 12, we have said it is an accounting device, device used to match the tax effect of a transaction, with its accounting impact, accounting impact. Now, in this case, what you need to note is that a deferred tax will arise as a result of the difference between what we refer as accounting profit and what we refer as a taxable profit. And even before we look on how deferred tax arises, I want us to differentiate between those two profits, that is what we refer as accounting profit and the taxable profit. Now, when talk about the accounting profit, this is what in other terms we refer to as the profit before tax, and this is a profit which is computed in terms of preparing the income statement, of which now for us to compute this profit here, we computed based on the various accounting policies and also the various accounting concepts adopted by an entity. So therefore we say that the accounting profit is the profit which is computed, is the profit which is computed or a profit which is based on the accounting concept and policies adopted by an entity, and what that means is that whenever now we are to compute now this particular profit here, that is the accounting profit, we take all the incomes of a business and then we less all expenses, meaning that the incomes now which we take into account, they may be taxable incomes or may not be taxable incomes. Still we less all expenses which may be allowable and which may be desirable. So that profit which now is reported by an entity after preparing the income statement, we refer to that as accounting profit. Now, on the other hand, we have the other type of profit known as taxable profit, Now, when talk about taxable profit, in taxation, this is a profit we talk of. And therefore, we say that this is a profit which is computed by an entity based on the existing tax laws, meaning that for us to be able to compute this particular profit here, we take only the taxable incomes and then we less all the allowable expenses. So therefore, we say that this is a profit, computed based on existing tax laws, loss. And therefore, what I've said is that for us now to be able to compute this particular profit here, we only consider taxable incomes and allowable expenses. So, mean that it is computed. It is computed using taxable incomes, incomes and allowable expenses. Allowable, or basically what in other terms we refer to as deductible expenses. Now, what we have said is that the reason why we have a deferred tax is because these two profit will be what? Will be different. And that particular difference between the two profit, that is the difference between what we refer to as accounting profit, the difference between accounting profit and the taxable profit may be classified into two categories. One, we do have what we refer as the permanent difference, and number two, we do have what we refer as the timing differences. So therefore, that difference between the accounting profit and taxable profit may either be permanent difference or a timing difference. Now, we need to know what is the meaning of those two terms. One, we have what we refer as the permanent difference. Now, when talk about a permanent difference, we say that this is the difference between the accounting profit and taxable profit, which arises because we have certain items of incomes and expenses which are considered or which are taken into account in the computation of accounting profit, but those items of income and expenses, we don't take them into account in the computation of taxable profit. Now, a very good example of that is what we refer as depreciation, what we refer as penalties and fines, because what we know is that for the purpose of computing now the accounting profit or that profit which is in the income statement, items such as depreciation, items such as fines and penalties, all those items are treated as expenses. But when we come back to taxation, we know depreciation, we know fines and penalties, they are disallowable expenses. So therefore, as a result of that, those two differences, those two profit will be will be different. So therefore, we have said that the permanent difference, this is the difference between accounting profit and taxable profit profit as a result of various items of incomes and expenses, expenses taken into account in the computation of accounting profit, taken into account in the computation of accounting profit, but not in a computation of taxable profit, profit. Now, those particular items of incomes and expenses, I've said that good examples will include, examples of such items include what we refer to as fines and penalties, We have what we refer as depreciation on property, plant and equipment, which is abbreviated as PPE. We also have what we refer as impairment loss on goodwill, impairment loss on goodwill. Now, what we know from taxation is that all these particular expenses here, we say that they are disallowable expenses. They are disallowable what? Expenses. But what we also know is that when preparing the income statement of a company, we take into account all these particular items of expenses here in the computation of the profit, or in the computation of the accounting what? Profit. So therefore, as a result of that, the accounting profit and the taxable profit will be what? Will be different. And basically that difference we refer to it as a permanent difference. And what we say is that this difference will only occur when those items are taken into account in the computation of accounting what? Profit, but not in the computation of taxable profit. But that difference will never occur again. Will never occur again. That's why that difference, we refer to it as a permanent what? Difference. So we say that this difference occurs only once. Occurs only once, meaning that once the difference between the accounting profit and taxable profit arises, it will not reverse in the future. It will not reverse in what? In the future. As a result of that, this difference do not give rise. This difference do not give rise to deferred tax. Does not give rise to deferred tax. Do not give rise to deferred what? A tax. And effectively what that means is that for the computation of deferred tax, we don't consider the permanent what? Difference. The permanent difference. Now, the other difference between now the accounting profit and taxable profit, we have referred to that as the timing difference. As the timing what? Difference. Now, when talk about this difference here, it is a difference between accounting profit and taxable profit, which arises as a result of taking into account various items of income and expenses in the computation of accounting profit and taxable profit, but in different accounting period. In different accounting what? Period. For example, we may be having an item of expense which is taken into account in the computation of accounting profit, maybe in the year 2019, but that item of expense will only be allowed for tax purpose maybe in future, like in the year 2022. What that means is that that difference between the accounting profit and taxable profit, which arises in the year 2019, it will then reverse in 2022. So therefore, this difference here is the one thing which give rise now to timing. It give rise to deferred tax. So first of all, we have said that this is the difference. The difference between this is the difference between the two profit. The difference between the two profits, profit, that is definitely the accounting profit and taxable profit, which arises as a result of taking into account various items of income and expenses, take into account various items of income and expenses in the computation of two profits in different accounting period, And therefore, what you have said is that this particular difference here, that is the timing difference, it is the one which will give rise now to what we refer to as a deferred tax. And I want to illustrate using a very, very simple illustration here how a deferred tax will arise, so that as we move forward, you'll be in a position to understand how a deferred tax do arise. Like maybe let's assume in the year 2018, a company reported accounting profit. Remember, we have said that to talk about accounting profit, this is what in other terms referred to as a profit before what? A tax. Maybe the accounting profit was 15 million, and then you are told in the same year, that is the year 2018, the depreciation on a certain asset which now was charged in the income statement was maybe 5 million, and then we also told that during that year the capital allowance maybe was like 8 million, and then still we are told the tax rate during that year maybe was 30%, and then what we are then required to do is to compute now the deferred tax. We compute deferred tax. Now what you have said is that for us now to be able to compute now the actual amount of tax which is supposed to be paid, that actual amount of tax should always be computed on the taxable profit. But in this particular case, first of all, for us to be able to compute this deferred tax, we say that during this year 2018, this company was supposed to pay all the amount of tax which was supposed to be paid. The amount of tax which was supposed to be paid this tax will be based on the profit. Will be based on what? On the profit, because generally what you have said is that the tax which is supposed to be paid should be based on the profit. Basically, when we talk about profit, or generally when we talk about profit, you are talking of the accounting profit, means that the amount of tax then which was supposed to be paid during this year will be given by the profit which was reported by that company, and then we multiply that with the tax rate, which is 30%, and that will give us 4.5 million. So during the year 2018, using the profit which was reported, that is the accounting profit, then this company was supposed to pay a tax of 4.5, but that is not the tax which will be paid, because the actual or the current tax which is supposed to be paid, we have said it is computed based on taxable profit. So therefore, what we need to do from this information, let's compute the taxable profit. We compute the taxable profit. Now the taxable profit in this case, what we know is given by what we refer as accounting profit. This we need to remember from what you did in taxation. Accounting profit in our case is given as 15 million. For us to compute the taxable profit, to this we need to add back any desirable expense which was deducted in arriving at that profit. Now, meaning that we need to add all desirable expenses. Now, from this information which we have here, where we have depreciation and capital allowance, we know that depreciation here, this is a desirable expense. Is a desirable expense, meaning that for taxation purpose, depreciation is treated as non-deductible or desirable expense. So therefore, what we need to do here is we come back and or we add back depreciation. We add back depreciation, which in our case is an amount of how much? 5 million. We add back that, and then once we add back, we are going to get 20 million, and then to that we are supposed to less the allowable expenses, which have not been deducted in arriving at that profit. Now, in our case, what we know is that when computing the accounting profit, a capital allowance is never included there as an expense, because this is considered in taxation, or basically when computing the taxable profit. So this capital allowance we know is allowable expense, but it has not been deducted in terms of arriving at that profit. So therefore, our allowable expense here is a capital allowance, and which is an amount of 8 million, an amount of 8 million. So once now we deduct that, in our case we are going to have 12 million. So this is now what referred as the taxable profit. Basically in our case, therefore, you can see that our accounting profit, which is 15 million, is different from the taxable profit, and therefore using this taxable profit, we can be able to compute the current tax. Remember, from our definition, we have said that the current tax is the actual amount of tax which is supposed to be paid. So therefore, the actual amount of tax which was supposed to be paid, actual tax, will be equal to 12 million times the tax rate, which is 30%, and this will give us 3.6 million, 3.6. So therefore, what we need to do here, if you compare these two taxes here, if we compare those two taxes, we have said that in the year 2018, based on the profit which was reported by the company was supposed to pay a tax of 4.5, but that is not the actual amount of tax which will be paid, because the actual amount of tax which is supposed to be paid should always be based on this profit, meaning that the actual amount of tax which the company will pay to tax authority or maybe to the government is an amount of 3.6, and therefore you can see that the company then has paid less tax than it was supposed to pay, and therefore the difference between those two figures there is now what we refer to as deferred tax, tax. So therefore the deferred tax in our case will be equal to what was supposed to be paid as tax minus 3.6 million, 3.6, and that will give us now a difference of 0.9. Now this 0.9 here is what we refer to as a deferred tax. Remember, what we have said is that in very simple terms, deferred tax is the tax which was supposed to be paid during the current year but has been deferred. It will be paid on a later period, or is a tax which the company was supposed to recover during the current period but has been deferred and it will be recovered on a later period. Because like in our case here, you can see the company was supposed to pay 4.5, but how much tax will be paid? 3.6, meaning that then the company has paid less tax than it was supposed to pay, meaning that this 0.9, then it is a tax which was supposed to be paid during the current year, but it will be paid in what? In future. Now, according to IAS 12, a company is required to provide for this, meaning that whenever the company is preparing the income statement, it should take now this particular accounting profit here, that is 15 million, the company is supposed to deduct what? 3.6 million. 3.6 now, remember here in our case, is the current tax, the actual amount of tax which is supposed to be paid. But other than deducting that particular amount of 3.6, the company is also supposed to deduct an amount of 0.9. Now this 0.9 is known as deferred tax, tax. Basically, deferred tax is not a tax which will be paid during the current year, but we have said this is just like a provision, because during the current year the company was supposed to pay 4.5, but it has paid 3.6. So therefore the company should provide for less tax it was supposed to pay during the current year, because by the end of the day it will have to be paid in what? It will have to be paid in future. So therefore, in very simple terms, that's how a deferred tax is, or basically deferred tax arises. So we are going to come to an end at that point in our first class. So in our next class, I think we will come back and we look on various aspects or more aspects of deferred tax, because we do have various approaches which are used in terms of computing deferred tax: income statement approach, a balance sheet approach. We look on those particular approaches as we look on more aspects. So therefore, for the time being, we take a short break and then we come back in our next class.
Hello, Lana. It's another session. We meet again. I want to welcome you to today's lesson. And today, we'll be doing lesson 2 under that topic. Just to bring you up to speed with what we are doing under this topic, we're discussing the entire process of identifying a good business opportunity. Remember, we did mention that at any given time, an entrepreneur has many ideas at their disposal, and they are the task of determining which of those ideas qualifies as the best opportunity for investment. We will have a recap of the steps involved in the process of identifying a good business opportunity. We said that process involves 3 steps. The first step being idea generation. The second step in that process being idea evaluation. And the third step being idea validation. Please note our discussion in lesson number 1 was idea generation. So our lesson number 2 is going to cover the other 2 steps in that process, which is idea evaluation and finally idea validation. We will start by looking at idea evaluation. In the first step, which was idea generation, the entrepreneur's objective was to generate as many ideas as possible so that they do not restrict themselves to implementing an idea that might not be the most optimal idea for them. So at step number 1, we ended up with like 10 ideas, for example. Now, we said it is literally impossible for the entrepreneur to implement so many ideas at the same time because of a lot of constraints that the entrepreneur faces, including resource constraints. So essentially, the entrepreneur believes that these are attractive ideas. They all qualify as potential ideas for implementation. But then again, the entrepreneur must determine out of these ideas which ones are worth considering. So the aim of step number 2 is to cull down those ideas to a smaller, manageable number. So an outcome of step number 2, we will end up with at least like 2 ideas, from which now they will eventually select the best idea. So how do we go about narrowing those 10 ideas into manageable number of ideas? We will do that through the process of idea evaluation. Please note, a good business idea, an attractive business idea is that which an entrepreneur accepts as a basis of an investment decision. So an attractive business idea is that which an entrepreneur accepts as a basis of an investment decision. You do not want to invest your money, your time and resources in an idea that is going to fail. Chances are out of these 10 ideas, not all of them the entrepreneur can implement and run successfully. Others, some of the ideas, some other people, because of some competencies they possess, they may be able to implement them. That is why we're calling them good ideas. Then the entrepreneur here is seeking those ideas which are within his or her reach. and which they will implement with ease and without struggling. So what that means is that all good business ideas do not qualify or will not always qualify as good business opportunities. Please note that business idea evaluation is the process of assessing which of these attractive business ideas qualifies as a potential business opportunity. Now, for an idea to qualify as a good business opportunity, meaning for it to be a basis of an investment decision, it must meet a particular criteria, a very simple criteria, and that is the criteria of feasibility and viability. So you can note that a good business opportunity is that which meets the criteria of feasibility and viability. These two will be the basis of eliminating some of these ideas. Now, what is feasibility and what is viability? The normal meaning of the words feasibility and viability, feasibility means practical. Practical meaning that which can be done, Viability means ability to generate a return. Ability to generate a return. It simply means profitable. So what that means is that some of these ideas are not workable. They are not practical for the entrepreneur. And some may not generate a sufficient return to the entrepreneur's investments. Then the question we ask ourselves, what will make an idea here feasible and viable? This brings us to a very important area, characteristics of a viable business opportunity or of a good business opportunity. Please note the terms idea and opportunity. An idea is transformed into an opportunity if it is accepted for investment, if it is accepted for implementation. If it doesn't, then it remains an idea. Now, the characteristics of a good business opportunity are what makes an idea viable and feasible. So we will define the characteristics as the qualities that make an idea feasible and viable. What are these qualities? We will list them down first. The first one is profitability. The second one is demand or market scope. The third one is growth and expansion, flexibility, we also have legality, followed by availability of finance, availability of skills, skill availability, and resource availability. These are the qualities that will make a business idea to qualify as a good business opportunity. What are they about? We are saying an important criteria for a business idea to qualify as a business opportunity is viability, which we are defining as the ability to generate a good return. So one important requirement that the entrepreneur must consider, he is an entrepreneur going to get a sufficient return for their investments. Will that idea help enable them make a good profit? There is a relationship between profitability and all these other factors, or most of them for that matter. For example, demand or market scope. If you introduce a concept into the market and there is nobody who is willing and who has the purchasing power, then it means you will make a very low level of sales, which might not be sufficient to cover your costs, and therefore denying you of good profits. So for an idea to qualify as a good business opportunity, there must exist some level of demand. There must be people out there amongst the population who either need to use or to buy and use that particular concept. Growth and expansion also has an implication on profitability. You do not want to tie yourself to the kind of an idea that cannot be expanded in terms of scale. Whether it is increased productivity, whether it's in terms of available space, whether it's in terms of machinery capacity, right? Or whether in terms of product diversity. A good business opportunity is that which, with time, you can always increase its scale. The fourth requirement is flexibility. Business conditions change every other time, including customers' tastes and preferences. Today, customers have these kind of specific needs. Tomorrow, those needs will have changed so that they desire other things. A good business opportunity is that which is dynamic. It can allow you to make changes and align what you're offering with the needs of the market. So in short, this can be viewed as responsiveness to the market needs. Legality. All businesses are conducted within a legal framework, and it is important that the entrepreneur complies with the regulatory framework. It is therefore not advisable for an entrepreneur to embrace an opportunity which violates the law, or in other words, which is going to be considered illegal, because this again will give rise to compliance risks. Availability of finance. Remember I said out of these 10 ideas, they are all good ideas, but not to everyone. Some may require heavy capital investment that the entrepreneur cannot raise. Maybe such capital requirement may be raised by others. A company which has a larger capital base may be able to finance such an idea. But from where the entrepreneur stands, they are not able to raise the amount of capital requirement. So it is important that the idea that the entrepreneur picks is within reach as far as financing the idea is concerned. Skill availability again, different concepts require the input of different types of skills. Know-how. You don't want a situation where you're starting a business and you will be importing the skill you need to manage that business, because maybe you cannot find skills locally. This is going to be very costly for you, and they will reduce the amount of profit that you will expect to earn from that kind of venture. Then there is resource availability. In business, you need input resources, most importantly, raw materials. Would rather be specific here and talk of raw materials. It is important that for the business to remain competitive, it is able to secure affordable raw materials. And those materials should be available in abundance, so that you do not run for 2 years and then the raw materials are depleted, so that you cannot continue with operations. So these factors here, or qualities, will be what the entrepreneur will consider in eliminating some of these ideas, so that they end up with 2 ideas. Effectively, after this assessment, the entrepreneur will find out that only 2 of the 10 ideas that they had generated will fit or will have these qualities present. And effectively, the entrepreneur can now proceed to the last step in that process, which is idea validation. And that now brings our discussion to the last step in that process, which is idea validation. Now, what is idea validation? You have now 2 ideas with you. You want to pick one. Which is now what you will venture or implement. You do not want to base your decision on guesswork. You want the decision to be an informed decision. So now you are taking your assessment of the remaining two ideas further. From just saying that an idea seems to be profitable, that an idea seems to have a good market scope, that an idea the amount of capital requirement is within my reach. I can raise that amount of profit. So that here you are quantifying those characteristics. In absolute terms, you are now going ahead to determine, to compute the amount of profit you expect to earn from each of these ideas. You want to quantify the level of demand. You tell us, in a month, I expect to have a turnover of this much. In a year, I expect to make this level of sales. You're telling us this kind of an idea requires this amount of capital investment. You're quantifying it in monetary terms or monetary value. So idea validation is a thorough screening of those ideas that meet the criteria of a good business opportunity. And the reason for this is you want to be very sure that you're basing your decision on objective information. So we are defining idea generation as a thorough screening, of those ideas that possess the qualities of a good business opportunities, of a good business opportunity. Now, this process requires you to go out of the office, to leave your desk, and go and find out reality on the ground. Go out to the market, determine the customer's preferences, determine the customer's purchasing power, determine the target population in terms of its size, in terms of population growth, in terms of its composition, gender, men versus female, adults versus children, because these variables are important when it comes to demand for the product. You're going out there to determine what is the cost of the raw materials that you'll be using. And in terms of quantity, are they sustainable? Can you use them for a considerable period of time without shortages or experiencing shortages for that matter? Now, the most common method used by startup entrepreneurs to validate business ideas is market research. So the main methods used in validating business ideas is market research. And this brings us to the item market research. What is market research? Market research is going to be defined as a systematic process of gathering, organizing, and analyzing market information or important market information that will enable an entrepreneur remove the guesswork from those ideas. So a systematic process of collecting, organizing, and analyzing important market information What is the aim of market research? You're conducting market research so as to remove the guesswork associated with a new idea or a potential business idea. And it is therefore the most sure way of telling that a business idea qualifies as a good business opportunity. All serious entrepreneurs will not introduce any new product in the market without having commissioned a thorough market research. What is the kind of market information or variables does market research seek to understand? The important information that the entrepreneur is looking for are important information. The entrepreneur wants to understand about the market. And which will inform whether to proceed with the ideas or not. Will include, among others, that is customers' purchasing power. Customers' purchasing power. The entrepreneur will also want to understand customers' taste and preferences, which determine demand for the product. The entrepreneur is also interested in determining competition levels. They're also interested in understanding the cost of inputs. They are interested in understanding government regulations to determine whether the idea is legal or not. Government regulations. The entrepreneur also wants to understand skill availability. You're also interested in understanding customers' location. Again, customers' location is important in the choice of where to locate your business. It's also important in determining how easy is it for those customers to access your products. It has an implication on how you intend to distribute your products. Because the more effective your distribution approach is, the more you're likely going to make increased sales. So essentially, when you look at these things that market research is trying to investigate, are what constitutes the qualities of a good business opportunity. Now, we will now look at the market research process. This process involves a certain set of steps. So, market research process. Or you can call it market research steps. This is a systematic process that follows systematic set of steps. The first step in the market research process is problem identification. That step is followed by research design, formulation. Once a research design has been formulated, you go to the field to collect the raw data collection. The data needs to be processed through the data analysis step. And finally, from the analysis, you'll be able to draw important conclusions. So, research reports. Now, the reason you want to carry out a market research is because there are things you do not know as of now. To you as an entrepreneur, that represents a problem, represents a situation that requires answers. This is a very important step in the market research process because this process is costly. It involves resources. Most times the entrepreneur does not have the capacity to conduct the market research, so that they will engage the services of market research firms, which will be at a fee. It will be very unfair for an entrepreneur to commission a research based on a wrong problem, because the entire process will be an exercise in futility. You will end up getting information, but information on the wrong subject. So the entrepreneur must take time to clearly understand what exactly do they want to know about the market. What is the question that needs to be answered must be clearly defined. Once the problem is now very clear, the entrepreneur formulates a research design. And what is a research design? A research design is the framework that the entrepreneur will use in conducting the entire market research. It is in the form of a blueprint, capturing each and every aspect of the market research process. Within this blueprint, the entrepreneur will have the timelines. You know, you cannot conduct market research for eternity. If you do that, then when will you ever implement the idea? Time is always a scarce resource, just like any other resource in business. So you must specify the time within which the exercise will be undertaken. You will, again, within the blueprints, identify the resources that will be needed. In terms of people, you need people to go out there to collect data in the field. In terms of facilities, you may need space in the business premises. You may need facilities like computers, which you will be using to feed in the data and process it. Within the blueprint, you will identify the methods you will use to collect data and the market research tools. If it is questionnaires, if it will be interviewing, you will provide for them. And every other thing that will be involved. So this is a document, a blueprint. Once it is complete, moving forward, it will act as the guideline. You will only be referring to what you have provided for in the research design. Once a research design is complete, now the researcher is ready to go out to the field and collect the raw data, the first-hand data that they need. And once enough data has been gathered, obviously it will depend on the time allocated in the research design for collection of data. It might be 2 weeks, it might be a month. Then that data is meaningless because it is very raw in nature. There is nothing much the entrepreneur can tell from all these large amounts of information that they have collected in the fields. So they will come back to the office and start organizing that information in a manner that makes sense. Break it down and using both qualitative and quantitative techniques, analyze it. The outcome of the analysis is inferences. The entrepreneur will be able to draw inferences. There will be findings from that information. Now, the information will make sense to the entrepreneur. It will have meaning. They will know what it represents. And finally, those findings and the entrepreneur's conclusions will now be compiled into a market research report. And on the basis of that report, the entrepreneur will be in a position to determine of the two ideas which is the best for implementation. And the entrepreneur will have an idea to proceed and implement. This brings us to the end of the topic, entrepreneurial opportunity development. Having successfully been able to identify one business idea for implementation from the very many ideas that the entrepreneur had generated. Thank you and see you in our next lesson.
Hi everyone and welcome to the Manifested e-learning platform. I'm happy to have you on this forum. In today's session, I begin the revision of the auditing and assurance paper that was done on Thursday, 2nd of September 2021. The paper has 5 questions. Candidates were expected to answer all questions. Marks allocated to each question are shown at the end of the question. These are 5 questions. And for the purposes of our revision, we'll be tackling a question at a time. In today's session, I'll revise question number 1. And before you proceed with this session, I urge you to try and see if you can answer the question on your own. Then you can come back and check how I've also answered it. We compare notes. That's the best way to revise. Don't be a spectator. I'll be answering a question at a time. These questions are at your disposal. Make sure you print the question paper ensure that you've attempted the questions before coming to this session. In our today's lesson, allow me to do only question 1. Then in our next session, we'll proceed to question 2 until we complete the 5 questions. Welcome to the session. Question 1 has 3 parts, A, B, and C. I'm first going to answer part A, which reads, controls in an entity's information technology system may consist of a combination of automated controls and manual controls. Required, Roman 1, evaluate 8 risks that automated controls pose to an entity's internal control system. 8 marks. Roman 2, analyze 4 circumstances in which manual controls may be more suitable for use in an entity. 4 marks. September 2021, question 1A, 1A, Roman 1. What is the question? Risks that automated, risks that eight risks that automated controls pose to an entity's internal control system. The first risk is that one related to the reliance on systems or programs that are inaccurately processing data. Number 1. Now, candidates relying on automated controls can pose the risk the risk on reliance on programs or systems that inaccurately process data, or processing inaccurate data, or both. So that is a risk. The second one is unauthorized access. There is that risk of unauthorized access to data, unauthorized access to data. Having automated systems, there is that risk that there are individuals who may have access to data, yet they have no authority or permission to access such data. There is always the risk that there will be unauthorized access to data, which may result in destruction of data, or may result in improper changes to data, including recording recording of non-existent transactions or unauthorized transactions. And the candidates particularly risk may arise where multiple users access a common database. Where many employees access a common database, then there could be unauthorized access to data, especially where passwords are shared. There is that risk that there are people who may have malicious intentions, and they may cause harm or damage to the database. Okay. The third risk is that there could be possibility of IT personnel gaining access privileges, gaining access privileges beyond those necessary, We are saying here that there is that risk that other than just unauthorized access, even those who have access, the IT personnel who have access may gain may access privileges that are beyond those necessary to perform their assigned duties. Unauthorized changes, there is also risk of unauthorized changes. changes. Those who have access to the database, for example, may make changes, yet they are not authorized to make such changes, unauthorized changes to systems or programs, right? Then number 4 or 5, the 5th risk is that one related to unauthorized changes to systems or programs. Unauthorized changes to the system or program or programs. This one is unauthorized changes to data. The other point is unauthorized changes to system or to the program. Number 6 is the risk of failure to make changes. Failure, there is a risk of failure to make necessary changes to systems or to the program, to systems or to the programs. There are times when there are changes that may be required to be made to the systems or programs, like updating the system, updating the application, updating the software. Where there is failure to make changes to the system or the programs, then that is a risk, candidates. That is a risk. And number 7, we can also cite inappropriate manual intervention. Inappropriate manual intervention. Appropriate manual intervention is also a risk. Number 8 is potential loss of data. Potential loss of data. When running automated controls, there is that possibility that data may be lost. Potential loss of data. There is that risk of potential loss of data or inability to access data, or inability to access data. And we know data can be lost through various ways. There are various ways through which data can be lost. There are various reasons why the users may not access data. That has happened many times. So when having automated controls, these are some of the risks that may be posed. Lack of skills, there is also risk in regard to lack of skills. Because candidate accessing the database requires some basic skills. Making changes to the programs, making changes to the systems requires also some level of skills. So there could be lack of skills or even competencies and competencies. We also know that technology keeps on changing. So if employee skills and competencies are not upgraded, then there is that risk that can be posed to an entity's internal control system. There are many risks we can cite: power failure, we can cite loss of audit trail, loss of audit trail, loss of audit trail, loss of power, and so on. Candidates were to cite 8 risks. These are more than 10 risks. Number 1, number 2, number 3, number 4, number 5, number 6, number 7, number 8, number 9, number 10. Any 8 risks here will earn 8 marks. 8 marks. Let's move on to Roman 2. Analyze 4 circumstances in which manual controls may be more suitable for use in an entity. Roman 2. circumstances in which manual controls may be suitable for use in an entity. We all know, candidates, the advantages of having automated controls in an entity, but there are circumstances or situations where having manual controls is more suitable than having automated controls. The question is, what are those circumstances in which manual controls may be more suitable for use in an entity? Candidate, this was an easy one. This was an easy question that carried 4 marks. All right, 4 marks. One obvious reason is the size of the entity. Where the entity is small entities, small entity. If an entity is small in size, then it may be suitable for the entity to have manual controls because of the cost implication and in terms of skills, in terms of equipment for automated and so on. Automation, because having automation for a small entity can be costly, may not be cost effective. So when the entity is small, then that's one circumstance in which manual controls may be suitable. Another point is where an entity has large, unusual, or non-recurring transactions. Large, unusual, and non-recurring transactions. When an entity does not process many transactions, then that could be a circumstance in which manual controls may be suitable, all right? Non-recurring. The automation or automated controls are suitable where the transactions recur continuously, routine. But when you have non-routine transactions, large, usual, and non-routine or non-recurring transactions, then that's a circumstance where manual controls can be used. The third circumstance is when there are insufficient skills. Insufficient skills. A company that has employees who are not skilled, non-skilled labor force, non-skilled workers. All right, to have automated controls, then there are certain skills that are required of the workers. But if workers do not have certain skills and competencies, then that is a situation for installation of manual controls in an organization. Okay. The fourth circumstance is circumstances where errors, you can say where errors are difficult to define, where errors are difficult to anticipate, where errors are difficult to even predict. Circumstances where errors are difficult to define, to anticipate, where errors are difficult to define, to anticipate, or even sometimes to predict and predict. Where it is not possible to predict errors, where it's not possible to define errors, where it's not possible to anticipate errors, then that is a circumstance to in which manual controls may be. So number 5, candidates were to give 4 circumstances. These are 4 circumstances. So we have circumstances in which manual controls may be suitable. We have small entities, and large, unusual and non-recurring transactions, non-skilled workers, where errors are difficult to define. So these are 4 marks. We have to give 4. We've given 4. That will earn you the 4 marks. Let's move on to part B of this question. Examine 6 factors that might be taken into consideration by an audit engagement team when determining the extent of tests of control to be performed. 6 marks. 6 marks. 6 marks. Part B. What is the question again? Factors that might be taken into consideration. Factors that might be taken into consideration by an audit engagement team when determining the extent of tests of control to be performed. Candidates, when answering questions in an exam room, make sure you have the root of the question. Don't just start by giving answers. Make sure you have the root or the preamble. Make sure the preamble is written down, then you can go ahead and give the points. Writing the preamble helps you candidates to identify the keywords, factors that might be taken into consideration by an audit team when determining the extent of tests of control. Test of control here is a keyword. The question is, what factors, on what basis will what will be the extent, what will be the extent of tests of control to be performed? Factors that might be taken into consideration. Factors that might be taken into consideration. The first factor here, candidates, is the frequency of the performance of the control. Frequency of the performance of the control. How frequent will the control be carried out? Because you know there are very different types of controls, including observation, recalculation, and so on. So how frequent will the control be performed with the action of testing? The test, how frequent will the test be carried out? Because this is test of control. How often, how frequent will the auditor carry out these tests? Is it a test of examination or observation or recalculation? How frequent? So this is a factor. If it is done daily, then that will determine the extent of the test of control to be performed. Length of time, number 2, is another factor. Length of time during the audit. The length of time during the audit period that the engagement team is relying on, the operating or on the effectiveness of the control. What is the length of time during the audit period? Time is a factor, candidates. Length of time during the audit period. That is a factor that will be taken into account or into consideration by an audit engagement team when determining the extent of tests of control to be performed. Number 3, relevance and reliability. Relevance and reliability of the audit evidence to be sustained in supporting that control. Okay? That is a factor to consider. What is the relevance? What is the reliability of the audit evidence to be sustained in supporting that control. Then number four, let me have it here. Number four, the fourth factor to consider is the extent to which audit evidence is, obtained from tests of control. The extent to which audit evidence, is obtained from the test of control. The extent to which audit evidence is maintained from the, or obtained from the test of control related to the assertion. Then number five, the fifth factor to consider is the extent to which engagement team plans to rely on the operating effectiveness of the control in the assessment of risk. Do you get that? The fifth factor to consider, I've said, is extent to which engagement team, extent to which the engagement team plans to do what? To rely. Extent to which the engagement team. Remember, the question is in relation to the engagement team. The question is, what are the factors that might be taken into consideration by an engagement team? So the answer here is the extent to which engagement team plans to rely on the operating effectiveness of the control, to rely on the operating effectiveness of the control, to rely on the operating effectiveness of the control in the assessment of risk, The last factor to consider by an engagement team when determining the extent of tests of control is the expected deviation from the expected deviation from the control. Expected deviation from the control. The expected deviation from the control is another factor to consider. Is the deviation expected to be large, or is it expected to be small? If it is expected to be small, then it will affect the extent of the control, the test of control. If the extent is large from the control, then the extent of the test will also be different. So that is a factor to consider. We can also have the size, number 7, the size of the organization that is being audited, organization, or the clientele, or the client, the audit client. They call it the audit client. The size of the audit client can also be a factor to consider when determining the extent of tests of control. If the audit client is a large, that has voluminous, many transactions, then the test of control will be large. We'll have to carry out many tests. Another point, obvious point, is availability of resources. 8, availability of resources. These are resources. These resources could be financial resources. These resources could be human resources. So the availability of resources can determine the extent of tests of control. If there are no sufficient resources, then the tests will be few. If the resources are available, then the company can perform many tests of control. So availability of resources is an obvious factor to consider by an audit engagement team when determining the extent of tests of control to be performed. So these are 8 factors. You are to give just 6. I've given you 8. 1, 2, 3, 4, 5, 6, 7, 8. Any 6 would earn the 6 marks. 6 marks. I'll now move to answer the last question of this part. Highlights 2 features of non-statutory audit. Features of non-statutory audit, part C. Features of non-statutory audit. Statutory audit, these are audits that are not required to be carried out by law. So what are the features of non-statutory audit? Features of non-statutory audit. We know that audit is not a legal requirement for all organizations. There are certain organizations that are not required by law to carry out audits, financial audits. But the question now is, what are the features of non-statutory audit? One feature is that the nature and the scope of the audit, the nature and scope of the audit, the nature and scope of the audit is determined by the audit client. Is determined by the audit client. If it's a small company, like say a sole proprietorship, audits that are carried on sole proprietors, there are non-statutory audits. So the audit, the extent and the scope of such an audit is determined by the sole proprietor, as opposed to statutory audit, where the scope and the nature is determined by law. All right? All right? Is that clear? Another feature is that this audit, the audit can be carried out, can be conducted any time. A non-statutory audit can be conducted any time, as opposed to a statutory audit where the law stipulates clearly when the audit ought to be done. For example, an audit of a sole proprietorship can be carried out any time, can be towards the end of the year, midstream, or any time, because there is no law that regulates the conduct of non-statutory audit. Another feature of non-statutory audit is that the auditor is required to, in a non-statutory audit, the auditor is required to conduct his examination within limits determined by the client. Okay? The auditor, I repeat, is required in a non-statutory audit to carry out his examination within the limits. Audit limits are determined by the audit client. The limits are set by the audit client, as opposed to statutory audit, where the limits are set by the law. We can also say that non-statutory audits are voluntary, It's not a legal requirement. No, they are done voluntarily. They are conducted voluntarily. So these are 4 features. I've given you 4. Question required to just to have 2. 1, 2, 3, 4. Any 2 marks? Yes, 2 marks. Any 2 features here would earn the 2 marks. Thank you for attending today's revision session. I'm happy to have you in this forum. In our next session, we're going to answer question number 2. Remember, we're reversing the paper that was done in September 2021. Bye-bye. Question 3B reads as follows. Your firm is the auditor of Deluxe Tea Holdings Limited, a company which is planning to list on the National Securities Exchange within the next 6 months. The listing rules of the Securities Exchange require compliance with corporate governance principles to which the directors are unsure as to the company's compliance status. The directors have requested for your firm's advisory on this matter. Additional information: number 1, the company's board comprises 10 members, 6 executive directors and a non-executive chairman and 3 other non-executive directors. The chairman and one of the non-executive directors are former executive directors of the company, and on reaching the retirement age were requested to take on non-executive roles. Number 2, the company has established an audit committee and all the NEDs are members, including the chairman of the board who chairs the committee. Number 3, all the 4 members of the audit committee were previously involved in sales or production related roles. Number 4, all the directors have been members of the board for at least 4 years. Number 5, as the chairman does not have an executive role, he has the sole responsibility of liaising with the shareholders and answering any of their questions. The company has not established an internal audit function to monitor internal controls. Required: identify 4 corporate governance weaknesses faced by Deluxe Tea Holdings, and for each weakness provide a recommendation to address it. How many marks? 8 marks. So there are 2 parts in this question. One is to identify 4 corporate governance weaknesses, and 2 is to provide recommendation to address it. And just the same way we answered part A, we are going to answer part B. We have 2 columns. The first column will be for the corporate governance weaknesses. On one side, we have corporate governance weaknesses. Then on the other part, we'll have recommendation to address. Recommendation to address it. Recommendation to address it. I'll use my blue pen. 2 columns. These are 2 columns. So, on one column, we'll identify the corporate governance weaknesses, and the other column we will suggest recommendation to address the weakness. Now, candidates, this is a question testing on the candidate's knowledge in corporate governance. Students who appear in the advanced auditing paper are presumed to have passed the strategy governance and ethics paper, because that paper is tested in section 5 of CPA, and this paper, advanced audit and assurance, is tested in section 6. So candidates were required to carry the knowledge that was acquired in strategy governance and ethics paper in answering this question. And the same way, these are the part of the question, part A, students were required to use the knowledge that was gained in the lower auditing and assurance paper that was tested in section 4. So these questions are similar in two ways. One way is that the knowledge required is knowledge that was acquired in prior sections. In the other way in which these two questions are similar is that in both questions, students were to identify weaknesses and suggest ways to address the weaknesses. Here, the weakness was in the system, the internal control system in relation to purchases. Here, the weaknesses are in relation to corporate governance. So candidates, there is no way a candidate can answer this question without having knowledge in corporate governance principles. Okay, in this question, there is no way you could answer this question without having knowledge of an ideal purchasing system. Okay, the controls, ideal controls in a purchasing system. So let's go ahead and point out the weaknesses. Note number 1. The company's board comprises 10 members, 6 executive directors, a non-executive chairman, and 3 other non-executive directors. That means that this company comprises of 6 executive directors and 4 non-executive directors. That is a weakness. The board is not appropriately composed. There is no balance between the executive directors and the non-executive directors. That is a weakness which we need to note down. Number 1, the board is composed of 6 executive directors and 4 non-executive directors, and that means that the balance between the executive and non-executive directors is not appropriate. Balance is not appropriate in order to make objective decisions. Objective decisions cannot be made because the board is not properly composed. So what is the suggested recommendation to address this problem? Recommendation. Half of the board should be should be comprised of the non-executive directors, okay, a half of the board should comprise non-executive directors. So how do you address it? You can say recruit and appoint additional independent non-executive directors. That is a way in which that problem can be addressed. That's it. Let's move on to identify any other weakness by reading through. We read the second sentence, note number 1. The chairman and one of the non-executive directors are former executive directors of the company, and on reaching the retirement age were requested to take on non-executive roles. The chairman and one of the non-executive directors are former executive directors of the company. Former executive directors of the company. Now, there lies another weakness, corporate governance weakness, all right? Being due to the fact that this chairman was a former executive director of the company, then that raises a question of independence. Independence. Can this chairman be independent? That's an issue that has to be addressed. So let me put down the weakness. We say number 2, as former executive directors, they were previously employed. They were previously employed by the company, and